Hello, everybody. My name is MJ the Tutor, and you are listening to Accounting Makes Sense, an MJ the Tutor podcast. This podcast focuses on helping accounting students all over the world by offering a quick warm up on various accounting and business topics that hopefully leads to the generation of bigger discussions and conversation. As part of the series I started before the CIMA case study sessions began, we've been looking at consolidated group accounts and the relevant accounting standards that come into play when dealing with group structures. This is the fourth episode in that series, and now, while today's topic isn't directly about group accounts, it ties in closely, especially when you're valuing companies for investments, mergers, or acquisitions. That's because intangible assets often appear in those calculations. You've probably heard of goodwill, which is one type of intangible asset. So today, we're diving into intangible assets more broadly. These are things in a business that don't have a physical form. You can't really touch them, but they still contribute real value and generate income. To make this more relatable, we'll use a simple example. So let's imagine we run a cupcake business. We bake, produce, and sell cupcakes. Yes, cupcakes. Hopefully, I don't make you too hungry, but they'll help us explain IAS 38 in an easier, more practical way. So, what gives a business value beyond its tangible assets? So, in our cupcake shop, the tangible bits are the ovens, the storefront, the mixers. But what about the secret recipe? The brand we built? The loyal customers who visit us every week? IAS 38 helps us think about how to recognize, measure, and account for these invisible yet valuable parts of the business. So let's start off. What is IAS 38? IAS 38 governs how businesses recognize and measure intangible assets, non-physical assets that bring future economic benefits for the business. Think trademarks, patents, or proprietary technology. Under IAS 38, an intangible asset must be identifiable, controlled by the entity, and expected to generate future economic benefits. But here's the kicker. Many valuable things in the business don't really meet these recognition criteria. So let's imagine we have a thriving local cupcake bakery. It's not just popular for maybe its red velvet cupcakes. It's got a distinctive brand, a loyal customer base, a killer Instagram following, and a secret family recipe. And you may ask, how much of the business's value shows up on its balance sheet? Spoiler alert, it's not nearly as much as you'd expect. So IAS 38 says we can only recognize an intangible asset on the balance sheet if it ticks a few key boxes. So first, it has to be identifiable, meaning either it can be separated from the business and sold, or it comes from some kind of legal or contractual right. Second, we have to control it. And third, it needs to be likely to bring in future economic benefits. Basically, it should help the business make money. Let's go back to the cupcake shop. Our secret cupcake recipe, that could potentially meet all those conditions. It's clearly separable, we keep it under wraps, we control it, and it brings in loyal customers. So, it's helping drive revenue. But what about our regular customers themselves? We love them, they're a huge part of our success, but unfortunately, we can't recognize them as assets. Why? Because we don't have any legal control over the customers, and they're not really something we can sell or separate from the business. So even though they're valuable, they don't qualify under IAS 38. Now let's get on to measurement. Once an intangible asset meets the recognition criteria, IAS 38 says we need to measure it at cost to begin with. If we bought the asset, like a patent or a trademark, that's pretty straightforward. It's the purchase price plus any directly related costs. But if we've created the asset ourselves, things get a bit more complicated. IAS 38 splits internally generated intangibles into two stages: research and development. Any spending in the research phase, like experimenting with new cupcake flavors just to see what works, has to be written off as an expense. But if we move into the development phase, say we're launching this new product cupcakes line and it has a real commercial potential, then we might be able to capitalize these costs. That is, if we meet 6 specific conditions, like proving the project is technically feasible, that we plan to finish it, that we can use or sell it, that it'll bring in future economic benefits, and that we can reliably measure the costs involved. If all those boxes are ticked, then those development costs can go on the balance sheet. Let's talk about these conditions a little bit more. First, we need to show the project is technically feasible. In other words, we can actually finish what we've started. So, if we're working on a new vegan cupcake, we need to show that it's possible to develop the recipe and that it works. Second, we have to intend to complete it and use or sell it. We're not just experimenting for fun. There's a real business goal at the end of this. That is, we do plan to sell this. Third, we need the ability to use or sell it, meaning we have the resources, like your skilled bakers, your kitchen space, and maybe even marketing efforts, right, to get this new line to the customers. Fourth, the project needs to be able to generate probable future economic benefits. Maybe we've tested the new recipe at a few locations and seen some really strong customer demand for it. That helps prove it's likely to be profitable. Fifth, we have to demonstrate our intention and ability to complete development. That means we're not going to abandon the project halfway through, and we can show a proper plan and timeline for it. And sixth, we need to be able to measure the cost reliably. That might mean tracking time spent, ingredients used, and other direct expenses related to the new product line. Only if all 6 of those are clearly met can we start putting development costs onto the balance sheet as an intangible asset. If even one of them isn't satisfied, it all stays as an expense in the profit and loss account. Now, let's talk about impairment and revaluation. Once an intangible asset is recognized, we have 2 options for how to measure it going forward. The first option is the cost model, which is the most common approach. With this method, we track the asset at its original cost, minus any amortization and impairment over time. This is the typical way to handle most intangible assets. The second option is the revaluation model. But this can only be used if there's an active market for the asset. This is fairly rare for intangibles, especially for something like our cupcake recipe, since there's really no active market where recipes are bought and sold. So for that cupcake recipe, we definitely stick with the cost model. Speaking of impairment, which is another part of this discussion, we need to assess the value of the recipe regularly, particularly if sales drop or if the recipe starts to lose its appeal. If the recipe's performance declines and it's no longer generating expected revenue, we need to recognize the impairment and adjust its value accordingly. So, talking about value, there is another piece to the standard which talks about amortization. Just like with physical assets, intangible assets lose value over time as they are used or as they age. Amortization helps us spread the cost of these assets across their useful life. For example, let's say we invest in a new product design, and we expect this design to remain popular for the next 3 years. Instead of counting the entire cost of the design up front, we spread it out over the 3 years. This way, each year's profit reflects the contribution of the product design to the business, rather than having a big hit to profits in year 1. Without amortization, we'd show higher profits in the first year when we've made the sale, but we wouldn't account for the assets decreasing over time. This could mislead us into thinking the business is doing better than it actually is. By amortizing, we're keeping the financial statements accurate and making sure that the cost of the product design is matched to the revenue it helps generate each year. In conclusion, I hope this episode has helped you to get to grips with IAS 38 and made it a bit easier to understand how intangible assets are accounted for, whether it's knowing when to expense it or capitalize costs, recognizing the differences between purchase and internally generated assets, or grasping the basics of impairment and revaluation. This standard covers a lot of ground. The key takeaway is to carefully consider the nature and stage of each asset to ensure you're accounting for it properly. For students, this should give you a solid foundation in how intangible assets work and how to apply IAS 38 in different situations. And that is it for me today. I'm your host, MJ the Tutor. Thank you for joining me. I hope you've enjoyed this episode, and I'll see you again next time. If you found this helpful, please be sure to subscribe or follow to catch the release of the next episode. You can also connect with me on various social media like Facebook, Instagram, X, Threads, BlueSky, YouTube, under the handle MJ the Tutor. You can also visit my website, www.mjthetutor.com. Till next time. Ciao for now!